Good morning, and thank you for joining us for today's event. All attendees are in listen-only mode throughout the duration of the call. If you are joining via computer, you can enlarge the layout by hovering over the small icon at the top right corner of the video and selecting Stage View. This will allow for optimum viewing of those who are currently speaking. We will be taking questions today following the presentation. If you have any questions during the event, please submit them via the chat function on the bottom right corner of your screen. All questions are submitted privately. In addition, if you have any technical difficulties during the call, please chat Truist Meeting and Event Services, and we will be happy to assist you. Ashley, the floor is yours.
Thank you, Emily. Hello, everyone, and welcome to Ditch Diggers Dialogue Volume 12. My name is Ashley Hudson. I'm the Operations Manager with the Heavy Construction Contractors Association. HCCA strives to provide educational and networking opportunities for our membership, so we created the Ditch Diggers Dialogue series as a virtual way to stay connected. Today, we have partnered with BB&T and SunTrust, now Truist, to deliver an update on the economy of the region. Thank you all for logging on. Next, you will hear from my co-host, Ken Ayers, who will begin the program. Go ahead, Ken.
Thank you, Ashley. As she mentioned, my name is Ken Ayers. I'm the market president for our Fairfax and Prince William markets. I want to thank, on behalf of the HCCA and Truist, want to thank each of you for your time. I know how precious time is. Hopefully, you will find the presentation meaningful. Many of you are members of HCCA already or clients of Truist, and we appreciate your business as always. If you are not a member of HCCA or Truist, we hope that at some point in time in the future, you will consider becoming a member or allowing Truist the opportunity to earn your business. If you're registered for this event up until March 24th, so on March 24th or before, you should have received a DoorDash voucher for lunch. So hopefully today you'll have the opportunity to take advantage of that if you are not doing so already. Just a comment about Truist. We're just outside of a year of our merger between two really great financial institutions, those being BB&T and SunTrust. The advantage of that merger was not only about being able to take advantage of our geography that we share, but also being able to pull out the best of both of those institutions and bring them forward into our new Truist Bank. And part of in that process of doing so, what we were able to come away with is an enhanced opportunity to deliver strategic advisory services, which is quite frankly what today is all about and is in perfect alignment with our Truist purpose, and that is to inspire and build better lives and communities. With that being said, I'd like to introduce to you to our speakers today, one of which is our very own Philip Avant. Philip serves as our investment banking generalist. He works with all of our commercial teams and partners with our capital markets group. And we are really excited, and I don't want to imply that I'm not quite as excited about Philip as I am Jeanette, but we are really, really excited today to be able to have the opportunity to have Jeanette Chapman deliver a message around the economy. I've heard, many of you may have heard her in the past. I know that I have, and she does a phenomenal job. Jeanette is the director of the Stephen S. Fuller Institute for Research on the Washington Region's Economic Future at the Schar School of Policy and Government at George Mason University. Jeanette, I had to take a breath in that, so that's a great title. So at this point in time, I'm going to turn it over to Jeanette. Jeanette, thank you.
Thank you. Thank everyone for having me. I really appreciate it. And I'm going to go ahead and share my screen so that everyone can see all the slides. And give me a holler if something isn't quite right, and that way I'll readjust. But I have about 20 minutes of material today on what's going on in the economy and its near-term outlook, really thinking through maybe 2024 at most. I always start off with the health trends whenever I'm talking about what's going on in the economy, because this really is the determining factor. This is what has driven the recession and therefore the economic trends have responded to this pattern. And there have been 3 phases of the health crisis in some ways so far, at least how it's been interacting with the economy. The first 2 phases are this chart in essence. Early in the pandemic, nationally, all places in the US pretty much reacted the same. We were all really looking at what was happening potentially either internationally or in New York. We weren't so much looking at our local health metrics. And so we started kind of way up at the top with this abstraction of what might happen in our communities. And so in March and April, that's really what the economic metrics reacted to most. And then starting around May, local consumers shifted their focus towards what was happening in their communities. And you can start to see the economic trends diverge depending on where you are. Now, in the Washington area, our trends have been moving together regardless of what sub-state area and really jurisdiction. And there's a little bit of noise in the numbers depending on how small the jurisdiction is that you're looking at. But generally speaking, our trends have moved together. And so our economy has moved together really for the first couple of phases of this. Now, when we entered into November, we had our second wave or second local wave of COVID. And towards the end of the wave, the most important thing became available to us, which is the vaccine. And so we've kind of shifted from looking at our new daily rates, at least it appears based off of these early data, and are starting to look more at our household level vaccination rates. And going forward, those will be more important than these local case rates, and I'll have more on that later. As I mentioned, early in the pandemic, most jurisdictions and most places, metros in the region, behaved fairly similarly, regardless of what their COVID case rates were. And really what we were looking at, I think, were these major metro areas, New York primarily, that were affected first by the COVID, their first local wave happened earlier. Those are in the blue line. We have the 15 largest metros in the United States are generally what we measure ourselves against as our peer metros. And 5 of those metros had early first waves. They had a very large pronounced wave of COVID in April that then subsided for the rest of the summer. We had a slightly later wave, but we were still in that first wave, just when you kind of, in terms of simplifying our groupings, we're shown in red here. And then the rest of the metros and the rest of the US really didn't have their first wave until the summer. And that, again, is when you start to see these rates diverge. So when you're looking at the national numbers and trying to figure out if it's what wave we're on, wave 1, 2, 3, 4, I think in some cases, we're really only in our second local wave. I've cut this off before the fall numbers. Every region had a second wave this fall, so it sort of gets distracting. All of this, though, directly affected consumer spending. Early in the pandemic, consumer spending dropped off between 40 and 50% in the local region and nationally. And you can see that we hit our trough in early April. This was, again, before our first wave had really picked up. Then we had a fairly robust recovery, and it plateaued. It's a little hard to see, but there's a little bit of a plateau this fall when it comes to consumer spending. The second thing about this chart is that there are some differences in sub-state area about where, or jurisdiction, about how deep the trough is and how recovered it is. And there are really 2 things that appear to have most affected this. The first is really what share of your population is young adults. Young adults like to spend a large percentage of their disposable income on entertainment and food and going out. And that still isn't really an option for most of them. And you can see that the District of Columbia and Arlington County have lower levels of consumer spending still compared to other jurisdictions in the region. They also are ranked 1 and 2 for the number of 25 and 34-year-olds as a share of their population. So that's probably what's driving that. The second factor is generally how much household wealth is in that county, where counties that have higher net wealth typically did not have as large of a pullback in their spending because they were less concerned about the long-term effects, whereas jurisdictions that had slightly lower net wealth tended to have slightly larger decreases. Now, when we look at what consumers continued to spend money on and what they stopped spending money on, I've broken this out into two charts. It seems somewhat intuitive, but grocery and food spending has been up throughout the pandemic. This is for DC residents, but I suspect that the relative trends are fairly similar throughout the Washington region. General merchandise and healthcare and assistance had relatively small initial losses and have more or less recovered by now as of late February, early March. These are things that tend to be a little bit more necessary and or in the case of general merchandise, are now being shifted to online retail. What's not shown in this chart are two things that are of some importance for the construction industry, and that is home sales have been very strong. There was a very large initial decrease, but that was recovered very quickly in the following months. And then also durable goods sales. Any of the big ticket items that require planning by households recovered a lot faster, and for 2020, they're typically up, not universally, but in general, those numbers held on much better than things that were consumed immediately. And that actually bodes well for the long-term recovery, and the simplification on that is that it's because consumers are treating this like a short-term disruption. They're going to continue to spend money on things that require planning. Things that did very poorly are, again, somewhat intuitive, but transportation and warehousing, arts, entertainment and recreation, and accommodation and food services. These all had the largest percentage decreases and are the least recovered. And all of this has a very large ripple through effect for the rest of the economy, which has resulted in, frankly, I don't want to call them catastrophic, but there really isn't a good way to compare what kind of losses we've had. And my attempt to do so is by comparing them with our past two recessions. And those lines are in blue and in green on this chart. The current recession is in red. And it compares the losses each month to the pre-recession job peak. And for this recession, between February 2020 and April 2020, we lost 12.6% of all of our jobs. That's almost 13% of our jobs were wiped out in 2 months. That's 4 times larger than the trough of either of these two past recessions. And it happened just catastrophically, or just tremendously more quickly. Generally speaking, it takes 18 or 35 months to reach the trough of your job losses, and in this case, it took 2. Now, the good news is since then, we've really recovered about 40% of the jobs that we lost. We did recover most of them in the summer, and you can see that since this summer, we've really plateaued. So now, between February and February, we're down about 6.8% of all of our jobs. Looking at the other large metros, we have outperformed them, but it isn't like the 2008 recession by a long shot. We still have had significant losses. They're just slightly milder than in other areas. And I've separated out these other metros into 2 because the trends here are affected by COVID. So the largest metros that were affected earliest, you can see that they had the steepest losses, but also the fastest recovery coming out of that in the summer months, and then that plateaued as we hit our second wave. And then the metros that were affected later, they had a smaller initial trough, but they didn't sustain their recovery nearly as well because their second wave really disrupted it. And again, a lot of this has to do with the COVID rates and then internally what kind of industrial composition that each of these economies have. And our economy is somewhat fortunate in that it may not seem like it, but we were protected by our industrial composition. And between February and February 21, we lost, as I said, 6.8% of all of our jobs. That's just shy of 230,000 jobs. We've never seen anything like this before. But there were 2 bright spots, only one of which is highlighted on this chart that I'm going to talk about. But the first is that federal government jobs continue to increase throughout the pandemic. This is a very large percentage of our economy, and so the fact that it was still growing was helpful in stabilizing us. The second piece is buried in this professional and business service sector, which is our largest sector. Most of the losses in this sector are in administrative and waste services, not in the white-collar, professional, technical, and scientific service jobs. Those held up very well, and we actually overall in 2020 had gains in that subsector. And in combination, that subsector and the federal government account for about 27% of all of our jobs. So a very large center, a very large core of our job base was stable during this period. Now, instead, the losses here are almost entirely a leisure and hospitality story. This includes food services, accommodation, and entertainment, and about half of the absolute decreases throughout the recession were in this sector, even though it is not our largest sector by a long shot. That sector, on a percentage point basis, as I'll show you next, also had very, very steep losses. The second largest absolute decline was education and health services. This is really anything that's not hospitals, ambulatory care, dentists, this is private education, so it's not school teachers from public schools, but it is all of the training programs that we have a lot of in this region. They did not fare nearly as well. On a percentage point basis, this looks a little bit better, but it still had fairly large losses. The third largest sector was this nebulous other service category, kind of in the middle of the chart. Other services in our region, about half of them are actually associations, and they did not have as large of losses as the rest of this sector, which is really the catch-all sector for personal care services, salons, dog groomers, car maintenance places. It's really just everything that doesn't fit anywhere else. And so that is the third largest absolute decline in our region. Moving on to the sub-state areas. Generally speaking, most of the difference in these trends is due to the industrial composition within these substates. It's not necessarily because one really outperforms the other in a meaningful way. And it's easiest to see with Northern Virginia and suburban Maryland that their trends are basically moving in parallel. Suburban Maryland has a weaker professional and business service sector, so it had slightly larger losses, and that's really what's accounting for this difference here. The District of Columbia is a little bit of an outlier because it does rely quite a lot on commuter spending that isn't happening right now, and so its food service and accommodation in particular are less recovered than in other parts of the region that are now. Suburban Maryland and Northern Virginia have more resident spending that offsets that. For Northern Virginia, as of February, it was down 4.9% in terms of its total jobs, 74,000 jobs just about. Again, like the Washington region overall, about half of this is in the leisure and hospitality sector, which lost 35,000 jobs. And the two sectors that were doing the best are the federal government and this professional and business service sector. And then you can also see the same pattern has emerged in terms of which sectors are underperforming by the most. And that is, state and local government is a little bit fuzzy, so I wouldn't focus on that one, but instead it's other services and education and healthcare. On a percentage point basis, this is what it looks like. Leisure and hospitality lost a quarter of all of its jobs, essentially, as of February. At one point, that they were down about 50%, closer to April or May, and so it's recovered by quite a lot. It just isn't there yet. It still has quite a ways to go. And I also want to point out that transportation and utilities on a percentage point basis towards the bottom of the chart has had some difficulties, primarily because of transportation. Even though we've been ordering more things online, that isn't enough to counteract all of the other kinds of things that usually we would be moving around for. So the transportation, the shuttle buses and the like, those jobs have been lost more or less. Another peculiarity of this recession is that we have been able to send our workers home. So we are not working in the same way that we used to. And our region is extremely well suited for working from home. Our industries were more or less able just to send everybody home. The white collar jobs that we have here are knowledge service workers, and we can do that fairly well remotely. And when you look at how compared to other places in the U.S., we have a very, very large share of our households that have at least one teleworker right now. This is as of February. About 58% of all of the households in the region as of February still had a teleworker. And this is more or less the same as it's been throughout the pandemic. These numbers don't change all that much, at least not for our region. That's a significantly higher share than the U.S. overall and for all of these other metros. And you can think San Francisco and Boston and Seattle, you would think that they would be right up there with us, and they kind of are, but we still have a larger share than they do. And that's when we start to think about some of the long-term effects. This chart raises more questions than it answers right now. But the second piece of this puzzle that I think is not being highlighted as well as it should is that we have actually had people leave the labor force as well. And this may be showing up in some of the construction workforce piece, depending on what kind of projects are going on for the audience. But anecdotally, I'm hearing, and the numbers bear this out, that there are some industries that are having a lot more difficulty than they would have thought getting workers back to work. And it's because they haven't become technically unemployed. We've had a very large increase in the number of people that have been unemployed between February, and this is charts through January, which is the most recent data, but we added just shy of 100,000 unemployed people during this time. But for every one unemployed person, 2 people left the labor force. And this is hopefully a temporary issue. And I say that because there's another survey that says, why don't you have a job? And there are 4 reasons that are directly associated or indirectly associated with COVID. And the first 2 are somewhat obvious, and they are tracked in those green, the dark green and the light green, where it's that worker was directly affected by COVID. They lost their job temporarily, they were furloughed, or they were laid off permanently. And those numbers have come down by quite a bit over the course of the pandemic. It's hard to see because it's a survey, so there's a lot of noise in the numbers. The other 2 lines, the yellow and the red, are likely why people have left the labor force at a greater rate than usual. And the first is that most of the children in our region are still doing at least a hybrid. Very few have gone back full time, or at least they're just starting to as of March. And that means that parents that may have needed to go into work, they work in retail or perhaps in construction, they need to have someone looking after their child or their children while they are not in the house, because the child is no longer in school. They're doing their schooling remotely. And that seems to have elevated the number of people that left the labor force because they were caring for children, at least nationally. The second one is actually a very realistic concern about either getting or spreading COVID. And many of the workers that could not work from home are in service industries with a lot of face-to-face contact. And if they themselves or they live in a household where someone has an elevated risk for a long-term effect from COVID, they may have chosen just to leave the labor force until that's no longer an issue. And so those 2 potential transitions will create some labor force friction as we try to reopen and as we start to move forward and getting things back to normal. And it may actually be very difficult, in spite of these very high unemployment numbers, it might actually be difficult for some industries to pull their workforce back in. Now, moving to the near-term forecast. The slowdown we had started in the fall with the second wave of COVID. Compounding that was also the cold, dark winter weather and the fact that we had moved a lot of activities outside during the summer and that it was hard to keep them outside during the winter. They just weren't as pleasant, and we could bring out as many heaters as you wanted. It was harder to get people out. Now, this appears to have lasted through February, and that in March and going into April, we should have a little bit of a spring bounce. It's primarily because of this pent-up demand and the fact that our COVID rates are down. and a little bit because of increasing vaccination rates, but that's not as important right now as it will be as we get into the summer and the fall. In the summer and the fall, our region will likely reflect the rate of vaccination more than the decline in the new COVID cases. Because as I said, our households appear to be very risk averse and looking internally now. Now, what that means is that it won't set us up for a full recovery until 2022. Vaccination rates, again, when you ask people, adults, if they will get vaccinated, there's a survey that the census has been doing, and you can separate them into the people that have either already had a shot. This is all self-reported, so the numbers don't line up perfectly with the administrative data, but have you had a shot, or will you definitely get one? That's the most confident answer. And in our region, that's 76% of all adults say that they've either gotten a shot or they are positive that they're going to get one as of February. This is the average of 2 surveys. And nationally, that's just shy of 64%, and our region has outperformed on this metric since they've been asking this question by upwards of 12 or 13 percentage points. And by contrast, when the share of residents in our region that are either hesitant about getting it or certain that they won't get it, it's significantly smaller. And even though this is a survey, it's well within the it's statistically significant. So this isn't just a rounding error or a margin of error issue. And our region is when you rank us against the other large metros, we are also well at the top of the list in terms of the number of adults or the share of adults that are positive that they want the vaccine, which is why I think that this number is going to be more important going forward. Altogether in 2020, our region lost about 197,000 jobs. Comparable losses were had in all of the sub-state areas on a percentage point basis after adjusting for those industrial composition issues. Moving into 2021, we're projecting that we'll get back about 65% of those jobs for each of these sub-state areas, more or less. The district is going to be a little bit slow, and Northern Virginia will be a little bit faster just because of again, it's mostly industrial composition issues. 2022 is when we'll get back the remainder of our jobs and then some. So we will have some growth in 2022 that's not just a catch-up growth, it's true growth that will help move us forward. 2023 is going to be what I call a repositioning year, because we will then have been through 3-4 years of almost a pandemic era planning. And that we will need to have a year where all of the businesses reposition and we figure out, okay, what really changed, what's the same, where are we going? So we're going to see some moderation in growth that year before growth in 2024 looks like a business expansion before we get back to that point. Now, on a GRP basis, it looks a little bit different, but for our gross regional product, we lost about 2.9% in 2020. We will have a slightly stronger rebound in GRP, primarily because of the advanced business investment and planning that needs to happen, but that our main rebound will still occur in 2022 before moderating slightly in 23 and then bouncing back up again in 2024. And with that, that is all I have, and I think I will pull up Philip's slide and hand it off to him.
Great. Thank you, Jeanette. And Jeanette and I have done presentations before, and I always find the information that you report out to us insightful and helpful to guide the businesses that we work with at Truist. So thanks for that. But with that as a backdrop, I may jump around in the slides a little bit here. And Jeanette, if you don't mind advancing 2 slides. There we go. And this is a very busy slide, but I think with some of what Jeanette talked about as a backdrop, I think this is probably the most important thing to start with. So Jeanette, first, one of the things she first talked about was the speed of the pandemic and how that impacted us economically in the United States. That we had seen some recessions that took 18 months before, and this one took 2 months. That is really the backdrop for what the government and the Fed needed to do to make sure that we recover. So let's look at this slide. We'll talk a little bit about how the Fed and the government helped us recover. We'll go back and talk about the various markets. And then we'll talk about what we are seeing kind of in the banking world right now, what seems to be most important to our clients. But we'll start with this. So we needed monetary policy to help get the world propped up again. And I typically compare this to what we saw in 2008 and 2009. So if you look at the box at the top left, in 2008 and 2009, the Fed had to step in because we were headed into a recession, and they really did a couple of things. One, they took Fed funds to zero, which took short-term rates to zero. We did that again this time around. They engaged in a quantitative easing program where they actually went out into the market and they purchased things like treasuries or mortgage-backed securities like Fannie Mae, Freddie Mac, et cetera. And doing that, they were pushing liquidity out into the system. And we are doing that again for the pandemic recovery. This time, it felt a little bit different. Some things happened in the markets that we had not seen before. And an example of that is the investment-grade bond markets froze. We did not see that in 2008 and 2009. So if you are an Apple or a Walmart or an Exxon and you wanted to go out to the bond market to raise capital, you could do that in 08 and 09 during that recession. You couldn't get that done this time around. So the Fed stepped in and did a number of things. They did take rates to zero. They engaged in a quantitative easing program, but they also backstopped for the first time the investment-grade bond markets, some asset securitization markets like securitizing credit cards and student loans and things like that. They backstopped the municipal markets, cities, counties, et cetera. So that was a first that we had seen. And if you look at the graph at the top right, and you look over on the very left, that gray shaded area is 2008 and 2009. That light purple line is the amount of quantitative easing that was done in 2008 and 2009. And that amounted to about, call it $1 trillion, a huge number. But if you look at the gray area on the right for this pandemic, the Fed has actually utilized its balance sheet to the tune of, call it, $4+ trillion to backstop the economy. So they've not only backstopped the public markets all the way through the investment grade bond markets, but they've also utilized their balance sheet to buy a lot of securities, propping up those securities and also getting liquidity into the system to a staggering amount, $4 trillion+. At the bottom, this is fiscal policy. So if you think about what the Fed can do, they can come out and put out a one-page press release that says we are standing behind the capital markets. And that's great, but that's typically great for public companies. It isn't necessarily impactful for private companies, at least to start. Private companies will typically follow along what is happening in the public markets. But fiscal policy was very, very important for private companies, the companies that generally we all work with every day. So at the bottom, you can see the dollars that were poured into fiscal policy. So under the Trump administration, you had the initial CARES Act, which was $2 trillion+, and then a couple of follow-ons. And then with the Biden administration, you have about $2 trillion. So adding all of this up, call it broadly $10 trillion. And sometimes I think the law of large numbers applies here. There are a lot of zeros. Sometimes it's hard for me to tell the difference between a billion, a million, a trillion. I would think of it this way. $10 trillion is about half of annual U.S. GDP. That's a massive number. Or you could think of it as about $30,000 of economic support per U.S. resident, also a very big number. So the Fed did its job, the government did its job. The Fed, what they did initially helped public companies but then the fiscal policy has been helping private companies along because it just takes more time to get checks into pockets and things like that. So Jeanette, maybe if you can flip backwards a slide. With the backdrop of what the Fed has actually done, take a look at what that did to the public markets. So the graph on the top left-hand corner is the S&P and the Russell 2000. So the darker line is the S&P 500. That sell-off last March was 30%, and it was fast. But the Fed and the government stepping in with monetary and fiscal stimulus has helped that market largely recover. The light purple line is the Russell 2000, again, publicly traded, but the smaller publicly traded entities out there. You can see how that trailed the S&P 500, but over really the last handful of months, that market has been recovering and actually outperforming the S&P 500. So smaller companies are finally getting the help that they desperately needed. I think this is also representative of one thing that we are seeing a lot of in the banking business. High multiples in stocks is symbolic of M&A, candidly. M&A, 2021 is likely going to be the year of M&A. We've been hearing that a lot. We agree with that at Truist for a number of different reasons. We have an aging demographic. We have business owners who went through the pandemic and don't want to do that again. There's concern about tax policy. And if you were to sell your business, how much you would have to give back to the government, et cetera. So there are a lot of things on the minds of businesses, and valuations for businesses are very high. And there are plenty of folks out there who are looking to buy businesses that now, I mean, Jeanette mentioned some of the vaccines and how that's rolling out and looking pretty good right now. There are a lot of businesses that are now comfortable to move forward with new projects and expansion. And there are a lot of businesses who think that scale counts in this economy that is more and more technology driven. So again, we think 2021 will be the year of M&A, and hopefully the tax tail will not wag the M&A dog. We hear a lot of that, but there are a lot of transactions taking place now to position businesses for the future or for folks to actually sell their businesses. So backing that up, the graph on the top right-hand corner, this is 5-year investment grade and high yield CDS. That's credit default swaps. But I would ask folks to think of this as basically the Dow Jones Industrial Average of credit spreads, or the margin above LIBOR or treasuries or swap rates that you would pay to borrow money. So again, staggering sell-off in March of 2020, credit spreads increased dramatically. This is part of the reason the Fed stepped in to back up the investment grade bond markets. But credit spreads have been dropping materially and have been almost getting back to pre-pandemic levels. So the markets are open for lending. Banks are looking for great assets. Businesses are recovering. So thinking about the M&A backdrop, lots of businesses selling and folks looking to buy businesses. A lot of people are financing that, utilizing bank debt or other sources of capital. And credit spreads have dropped a lot. Rates are low as well, general rates, LIBOR, Fed funds, et cetera, treasuries. So all-in borrowing costs have become low again. So we're seeing a lot of different things happen in the markets for businesses to kind of reposition themselves. I'll hit on the bottom couple graphs here. The bottom left is metals and energy indexes. We really just picked a couple of different commodity indexes to talk about. Same story in March of last year. Big sell-off. I mean, generally, if it was publicly traded and you could sell it, you did. But we have seen the metals markets and the energy markets fight back significantly. At one point, crude oil in the May timeframe last year actually settled at a negative price because no one was utilizing oil. People would pay you to take it off their hands, we had never seen that before. But crude has been increasing dramatically. And then you look at the metals, which has gold, silver, copper, et cetera, and that has been increasing dramatically. And that's a product of a couple of things. Really, folks are looking to have real assets on hand. thinking that the U.S. dollar has been devaluing. It has been. It's about 10% down since last March. So actually having hard assets that you can touch on hand makes some investors pretty comfortable. It's also a reflection of businesses opening back up, but also broken supply chains that are repairing themselves right now. There's a lot of demand for materials. So commodities have been increasing significantly in price. And then on the bottom right, the line that you see that's increasing on the very right, that's the 10-year Treasury yield. So when the Fed stepped in and basically started buying bonds again, we saw the 10-year note get down to as low as 0.5%. It's negative in places like Germany, France, et cetera, but in the United States, it got down to 0.5%. All of this buildup for economic recovery has been driving a lot of discussion around inflation. So the 10-year Treasury reacts to really a couple of things: prospects for growth and prospects for inflation. And right now, both of those are in play. So the 10-year note has been hovering around 1.7, and we've seen that increasing really over the last couple of months. So I think the themes that I would want folks to hear are that the M&A business is open. There's a lot of that going on. We're hearing from our clients on that all the time, every day. The borrowing markets are open again, certainly for Truist, and rates are generally low, and credit spreads are low. But we are also hearing that inflation is going to start becoming a concern. And the Fed is actually on record in saying, okay, we want to make sure this recovery takes place. So we're going to let inflation run hot for about a year before we step in and take the federal funds rate up. Whether that happens or not, we will see. If the markets continue to see increases in things like the 10-year note, they may have to step in earlier, but they are not wanting to do that at this point. So Jeanette, if you'll flip a couple of pages forward, what are we seeing going forward? What are the concerns? We've talked about the themes for 2020 with M&A, borrowing, prices up, et cetera. If you look at the graph on the top left-hand corner, the dark line is where we are today for the Treasury curve. You can see that that's steepened out. That's a reflection of concerns about inflation, but also prospects for above average growth relative to where we were last year. But really the two biggest concerns that folks have, if you look at the graph in the middle on the right, that's CPI. That is full CPI. It includes food and energy. It is starting to tick up. We are expecting 2%, 3%, 4% numbers to show up in CPI. And if we have business owners on the phone, I'm sure we do, when it comes to buying commodities or buying inputs for the products that you make, I am sure you are seeing prices increasing. That will bear out in some of the CPI and PPI numbers that we will see going forward. So inflation is a big concern. And then also, how did the vaccines go? Did the variants create issues? We're doing a lot of vaccinating in the United States. In other countries, there are some countries that have not vaccinated a single person. The variants spread there that end up coming to the United States and just create more issues for us here. It's a global concern, a very valid global concern, but inflation and the variants and how that will play out is likely going to set the tone for the markets. But right now, $10 trillion of capital that's been pushed into the economy, and there just seems to be a great backdrop for recovery in 2021 and beyond. So I am going to pause there and Ken, maybe flip it back over to you or to our host if there are questions that we can address.
Great. Thank you, Philip. I appreciate it. We will now move to the Q&A portion of the event. We want to hear from you all, so we will facilitate Q&A by using the chat function within WebEx. If you're joining via computer, you can find the chat box on the bottom right-hand side of the WebEx window. If you are joining from the WebEx app, you can find the chat by selecting the settings button cog to the right of the red X. We did receive some pre-submitted questions, so we'll go through those before we get any in the chat. First question, overall, how does the commercial real estate and construction business look in the region?
I'll take a shot at that. Let's talk about nationally first. I think construction and commercial real estate were down generally 5% or so nationally last year. And the expectation for this year is that it will be flat. I think the expectations are the same for the greater Washington region, but it looks different. For instance, than a lot of different places in the country. I live in Richmond, Virginia. The commercial real estate outlook and the construction outlook here is kind of consistent throughout the region. But if you think about some of the numbers that Jeanette put out, right, the ability to work from home in DC specifically calls into question the velocity of commercial real estate building specifically in the district. So we will see what that looks like. But I would say for suburban Maryland and in Northern Virginia, we would expect greater than average growth relative to the rest of the United States. But one of the big concerns, and we hit on this with that commodities graph, right? I mean, if you were buying wood, metal, et cetera, whatever is needed to build, those prices have increased materially. I mean, for instance, the lumber prices that you see out there are staggering relative to where they were last year. So costs are going up, but I would say, you know, that DC proper, there's probably going to be some evaluation of how much space we need in DC proper on a go-forward basis. But Northern Virginia and suburban Maryland will move along. And I think everyone on the phone here knows that the greater Washington region, when it comes to resilience relative to recessions, depressions, that type of thing, it fights back hard, just having the federal government right there. So I would expect good things certainly in the long term.
Yeah, and I'll add on to that a little. Oh, if it's okay, I'll add on to that a little bit. So before this pandemic, I think there's a strong case that at least suburban Maryland was slowing down. Its new commercial office space was essentially cannibalizing its existing stock. So that was starting to reach a tipping point. And I agree 100% with Philip that things will probably level out probably for a year or two while we figure out really what these long-term changes will be. Now, I'm a little bit of a contrarian in this potential. I think nationally, the headlines, at least early on, were that we were all going to be working from home forever, and that would decimate city centers and all of that. But I'm also old enough to remember that this isn't the first time we've had this conversation. We did it in the 2000s with the easy access to the internet, where we were going to have this world flattening. That didn't happen, and actually the reverse happened. The larger metros grew faster than the smaller metros during this time, and there weren't as big of shifts as I think many people thought were going to happen with these center cities. The second contrarian point of view that I will have is that I think if you're maybe over 50, it's much easier for you to transition to work from home forever because you don't need training. It's the under 50s that need a lot of, I'm saying 50, it could be 30, it could be whatever the right number is, but the younger adults need training that happens in the office, and it doesn't happen necessarily through a direct training program. It happens through observation. It happens through listening and paying attention to what's going on in your surrounding. And I think that as we reopen, that there may be people in the upper echelons that underestimate that effect, and that when they start to move people to work from home, they realize that it's much more challenging to train people up, and then they're going to force everybody to come in 3 days a week, which would then minimize the effect on commercial real estate. There'd be some repositioning, but that's my 2 cents on that, for the long term at least.
Excellent, thank you. Next question, do you have any thoughts or opinions on the proposed infrastructure package?
So, and you know, still more to come, and I think Biden is going to be in Pittsburgh today talking about this. Well, first, I think it could become a bit of a political football from a couple of different perspectives. We talk about the $10 trillion that's been injected into the system. This is another $2 trillion. So when it comes to Republicans and certain hawks as it relates to debt, inflation, and things like that, you're going to have some complaints and saying, this is just more debt that eventually someone in the United States, our children, grandchildren, et cetera, is going to have to pay back. So just the size of it will be one thing. And this is the first material conversation I believe we're going to have around taxes, since the proposal assumes that corporate taxes will effectively pay this back. So how hard did the Republicans dig their heels in here symbolically, because this is the first real conversation around taxes. So that's kind of a starting point is, this is going to be the first real back and forth, in my opinion, in Congress that we see. But I mean, generally infrastructure packages are a bipartisan, supported type of thing. And, Republicans, Democrats alike should candidly like what we're wanting to do over the long term. So there's a lot of transportation in this, but then it also kind of steps into normal services, water, broadband, that type of thing. There's a lot more in this package than what folks normally think of as infrastructure. So I think there's some great things to come out of this. I mean, I know Ralph Northam yesterday with Pete Buttigieg announced some things that were done for Virginia that are infrastructure related. And a lot of people are excited about that. So I think it's some heated debate, but hoping we get there for some of this one way or the other, whether it's in this bill or it's placed in other places. Certainly around the greater Washington region, I think it's necessary, but it's a political football.
Fantastic, thank you. And we did receive a question from the chat. What is the effect of stimulus checks and unemployment insurance payments keeping individuals out of the workforce?
I'll attempt to answer that. And the main answer is that we won't really be able to assess that for a couple of years. And I actually think it's probably smaller than the anecdotes would suggest, just because of the magnitude of the wage losses vis-a-vis or relative to the stimulus checks that these households are getting. My guess is that actually it is the two things that people say that they're concerned about, either getting or spreading COVID or issues with childcare, are going to be more important in the long run in keeping people, or even in the short run, in keeping people out of the labor force than the relatively small, in the grand scheme of your annual wages, stimulus check. That said, that doesn't mean that it isn't happening. I'm sure that it's happened to some degree. It's just that degree is probably a smaller share of the overall situation.
Thank you. Okay, we do not have any other questions in chat. Actually, nope, this always happens. We just got another one. So what are your views on recovery of CRE in DC and the support services that thrive on DC office space?
Janet, you want to take that one, or you want me to give it a shot?
Sure, I can give a shot. I think the DC proper will have a slower recovery just in getting its workforce back. And I also think what that will do is it will slow down the planning process for construction. Even the Class A will probably slow down some, just because we don't really, it isn't a matter of risk, it's a matter of uncertainty at this point. And I know that there's a sort of semantics difference there, but we really don't have an idea about businesses. If you ask businesses right now and you asked them 2 weeks ago what their plans were for work from home, they don't know necessarily, and they may have changed their minds already. It's just, there's just too much that we don't know that's going to happen yet. And construction, I think, is going to slow in response to that. Though, would not say that some people are very, very pessimistic about the CRE market in central cities. I am not that way. Cities have a very long history. They exist for a reason. They're more efficient. People function better in them. There are all sorts of secondary benefits, and the pandemic didn't erase those secondary benefits. All it did was tell us that we have a few more options than we used to, and those options will change things on the margin, and they will probably mean that smaller companies offload their commercial space and move to this sort of hybrid. That's my guess. But large companies right now don't seem to be making any moves. And so the District of Columbia, that in combination with the fact that it is anchored by federal government, law firms, high value associations, all of which value having a presence in the District of Columbia, they could conceivably be anywhere that has cheaper costs, but they've stayed there. Those are really the backbone of the district's economy. So when it comes to the add-on services, those will be slower to recover because it will take time to get people back into the office. They will recover, though. They may not look exactly the same, and they may have more flexible hours, but they will recover. That's my 2 cents on that.
Fantastic. Thank you. So we do not have any more questions in the chat. So at this time, I'll turn it over to Ken, and you can close this out.
All right. Thank you so much. Thank you, Jeanette and Philip. Awesome job. Meaningful information. Hopefully everybody enjoyed that. I also want to thank Ken Garrison and Ashley for their participation in today, and the HCCA couldn't have done it without you. So on behalf of the HCCA and Truist, we hope all of you have a great day and rest of your week. Thank you.
Thank you.